Focus. Ideate. Innovate. Enable. Kotak Mutual Fund presents Investmentor in association with Network 18.
Hello and welcome to this special show. Kotak Mutual Fund presents Investmentor in association with Network 18, an investor education initiative by Kotak Mahindra Mutual Fund. I'm Harsha Upadhyaya. Now today on the show, we are going to be discussing two different types of mutual funds that have a very specific role in an investor's portfolio. The first fund that we'll discuss is going to be the ELSS category of funds. ELSS, or equity-linked savings scheme funds, offer tax exemptions to investors, and thus they are a very popular route for tax saving for many individuals. Now, the other category of funds that we'll talk about today are hybrid funds, which invest in both debt as well as equity instruments to achieve diversification and avoid too much concentration risk. So let's get started and learn more about both of these product categories and why perhaps they need to be in your portfolios. Well, joining me on the show to do this are Harsha Upadhyaya, President and Chief Investment Officer, Equity at Kotak Mahindra Asset Management Company, and Devender Singhal, Executive Vice President and Fund Manager at Kotak Mutual Fund as well. Two very interesting categories, and Harsha, I've got to start with what else but ELSS, right? You know, the ELSS category ends up being the first step, the first CD, as they say, for lots of investors as they get into the world of mutual funds, because we all want to save tax. So tell us more about the category itself, its design, and the objectives, and how the ELSS funds are perhaps different from the others. Harsha.
To most investors, this becomes the first step because not only it gives you diversified exposure to equity asset class, but also gives tax benefits. For example, equity-linked savings schemes, or the tax saver funds as they're popularly known as, they are part of the ATC exemptions. So up to 1.5 lakh rupees of investments every year can be tax exempt in this category. So people can use this to grow their wealth as well as save tax on the maximum limit of 1.5 lakh rupees from their taxability. If you look at the objective of the scheme, there is a lock-in of 3 years, which is also the lowest amongst all other tax-saving investment avenues. And it takes a diversified exposure to Indian equity. So the lock-in allows fund managers the flexibility to invest in stocks which may have lesser liquidity, and he does not need to really worry about daily inflows, outflows to the same extent as other diversified funds. And similarly, since the investor is locked in for 3 years, usually the experience of the investor is also better because he can handle interim volatility much better.
But Harsha, the question is that is the process itself different? The way in which stocks are being selected? Do ELSS funds invest only in certain type of stocks or companies? Is there a sector bias? Basically, is there anything different in any other diversified equity fund and the ELSS fund?
From a regulatory perspective, there are no other restrictions as such. There is no cap on allocation into large cap, mid cap, or small cap. Similarly, there are no sectoral investment restrictions. So it has the complete flexibility that a diversified Flexicap fund would have in terms of investing into all the available options. As I mentioned earlier, the only advantage is the portfolio manager can definitely take a more long-term view on the stocks, since the money that comes into the fund is locked in for 3 years. To that extent, it gives more flexibility for portfolio management.
Okay, fair enough. Let's bring in Devendra into the conversation as well. Devendra, you tell us, what is the usual experience like? And I don't think there is any sort of a minimum or maximum amount. You can actually invest even above the 1.5 lakh limit, right? Of course, you won't get more tax advantage. But any other rules and regulations that we should be aware of when it comes to ELSS funds?
No, I think Harsha put it beautifully in terms of what are the regulatory approvals or the framework which is being there for the ELSS funds. The only thing which I remember is that you cannot use derivatives into ELSS, while you may, with permission, use derivatives into the other equity funds. So I think that's one additional feature which is a kind of a restriction which is there in ELSS.
Okay. But Harsha, while we invest in these funds, that amount would be exempt from tax. But I'm guessing at the time of withdrawal, whenever the 3-year lock-in is over, then I'm guessing there is tax to be paid like there would be in any other equity mutual fund, right?
Yes, Surabhi. Exactly treated like any other equity fund. For example, any equity fund which is held for a period more than 1 year comes under long-term capital gains category. So similar treatment would be there for even tax-saving funds because inherently these have 3 years lock-in. So you end up with long-term capital gains after 3 years. So it will be exactly treated like any other equity mutual.
Okay. So, the question here that comes is that, if a person is looking at their overall equity portfolio, Harsha, and ELSS will already take up a certain part of it. Then does it take care of, let's say, your large cap needs? Because the thumb rule that we've discussed in the earlier episodes of this series is that for a medium risk investor, the large cap category is your go-to category. First, make sure that the bulk of your investment goes there. So now that you also have to do ELSS to save tax, how do these two sort of balance out?
I would say that most ELSS funds will have exposure to large cap. Most of them are run like Flexicap, which means there is a mix of large, mid, and small cap at various proportion. And also it gives you tax advantage. So I think even before you look at a large cap fund, for first time investors, it makes sense to take exposure in ELSS funds because it gives you a diversified exposure. May not be 100% large cap, but definitely there will be a significant diversification that comes with ELSS funds across market cap. And also you will get the tax benefit. So I think it can be used for both these purposes. Okay.
Devendra, so now help us out here. Now that we know the construct and we understand the whole design and why these funds are needed, what's the right way to choose one? What are the different factors that an investor should perhaps keep in mind while taking up a tax-saving fund?
See, like any other equity fund, when you choose, you look at the quality of the portfolio, you look at the biases which is had in terms of large cap, mid cap, or small cap. And then in terms of performance ratios, if you basically think all these things are aligned with your investment goals and the risk profile you have, that is one which you want to choose in. And then everything being equal, you basically end up looking at which is the lowest cost fund, which would basically give you in that sense. So I think apart from basically looking at the quality of the portfolio, you look at the risk reward ratios which the fund gives you and the track record, and then everything being equal, then you go down to looking at how the cost structure is being there.
Okay. Harsha, beyond investment from a tax-saving angle, is there any other need for an investor to look at the ELSS category, or are they just better off in a Flexicap? The reason I'm asking is that people with incomes above a certain threshold, perhaps their ATC will be met by their regular housing loan or maybe their LIC policies or some of the other sort of categories which are there under ATC. Then should people still consider ELSS, or are they better off going for a Flexicap or any other category of equity funds?
For such investors, obviously, there are many other options as well. Flexicap being the first one, given that it is also as diversified as an ELSS is. Thereafter, one can choose between various other capitalization-oriented funds or thematic funds, depending on risk-reward that is in mind. So I would say that for saving tax, definitely this is the best option amongst many other options that we have, since it comes with a lower lock-in as well as an exposure to equity asset class, which means that the strength in the underlying economy will determine overall returns over a period of time. So those who are trying to save tax, definitely ELSS is the best option. For those who are not just looking at saving tax, along with ELSS, they can also look at various other categories.
All right, so I think that educates us about the contours and the benefits of being in a tax-saving mutual fund. What we'll do is we'll take a break, and on the other side, we'll shift to the next category that we promised we'll talk to you about, and that is the hybrid fund category. Very, very important for your portfolios as well. We'll come back with all of the details.
Kotak Mutual Fund presents Investmentor in association with Network 18. Kotak Mutual Fund presents Investmentor in association with Network 18.
Welcome back. You are with this special show. Kotak Mutual Fund presents Investmentor in association with Network 80. Now, this week we're discussing two important fund categories. One is the ELSS, or the tax-saving category that we've already discussed. Now, let's talk about hybrid funds. Now, hybrid funds, as the name suggests, are a hybrid of two different asset classes, equity and debt. And remember, on the show, you have heard a lot of experts always tell you that asset allocation, having the right mix between these two, is extremely important. So let's straight away take it to Harsha for some opening thoughts here. Harsha, there is the do-it-yourself way where I can choose, a certain number of equity funds and a certain number of specific debt funds. And then there is a hybrid route. Why should one look at the hybrid route to begin with?
So the hybrid route gives you exposure to two asset classes at the minimum. It means that instead of worrying about picking multiple funds in equity as well as fixed income, you can very well invest in one hybrid fund, and that will take care of your equity as well as fixed income allocation. And we all know that from a longer term perspective, having a prudent asset allocation is something that is really, really critical, because many asset classes move in tandem at various points of time. If you don't have diversification between asset classes to the optimal level, your returns will get affected. So that's the reason why one is required to do prudent asset allocation. And instead of doing it in multiple funds, the hybrid funds give you an option to do it in a single fund. So that's the advantage.
The hybrid category itself has different types of funds. So now, Devendra, help us out here and tell us the different categories within hybrid that the market regulator has outlined.
So, Surbhi, as Harsha mentioned, that it's a hybrid fund is a fund which has a minimum of two asset classes within. So, equity and debt are the two basic categories whereby the investors put their money into. So, hybrid funds, you can simply put it, the categorization as per the SEBI depends on what is the minimum and the maximum level of equity one can go into a fund. So the most conservative fund in the hybrid category is basically the debt hybrids, which have 75 to 90% of the money invested into debt instruments. The 10 to 25% of the money is invested into equity. So that is category one within hybrids. Then you have another category, which is equity saving funds, which has a minimum of 65% invested into equity and related instruments. However, this equity can be a combination of directional equity, which is a pure equity, and arbitrage. So while many of the SEBI also ask funds to mention the maximum directional equity a fund would have in that category. So typically, we have seen that category has 20 to 50% equity directional, the balance being spread into arbitrage and debt securities. Then you have another category, which is equity hybrids, what we also known as balanced funds. These are now two types. One is conservative and aggressive. SEBI allows one fund house to have only one fund in this category, depending upon whether you want an aggressive fund or a conservative fund. So that is third. Then you have a multi-asset fund, which basically has more than two asset classes. In fact, the regulator defines it as a fund which would have a minimum of three asset classes. Which three asset classes would be there? That is open to the fund house, and they have to specify it at the time of the inception of the fund. So that is where things are, and they have full flexibility in terms of moving across the asset classes.
Okay.
So you can have a minimum of 10% into each of the respective asset class, which you mention into your scheme information document. Now, there's a new category which is being coming up, which is called Balance Advantage Fund. This as a category can move very widely in terms of where your equity allocation could be. So for some, it could basically move from as low as 20% to as high as 80%. So depending on the fund manager's view on the market, the equity allocation can vary in this category.
And just for the point of taxation, because at the end of the day, we need to be very certain about how that fund is getting taxed. What's the rule, Devendra? Above what threshold does a fund get equity taxation? Because taxation, if it's being treated like debt, is going to be different. So is there a cutoff limit that an investor should keep in mind?
Yes, there is a cutoff limit. So any fund which has 65% or more of equity and related instruments, that would be taxed as a equity taxation. All the other categories would be taxed as debt taxation, including the fund of funds that would be taxed as a debt taxation. That would have a debt taxation.
Okay. So, Harsha, now we've understood a lot of these categories which are on offer, which investors can choose from. So how do you sort of begin? And if you have to match a hybrid fund to your risk profile, and if I'm talking about a medium risk investor, doesn't want to sort of get into too many exotic areas, then what sort of a hybrid is perhaps best suited?
For those moderate risk category investors, I would say that a multi-asset allocator would do the job. However, these two come with debt taxation. If you are looking for equity taxation with a moderate exposure to equity, then you would have to ideally pick up one of the equity hybrid funds or one of the dynamic asset allocation products, which is essentially balanced advantage fund. So depending on what kind of taxation structure you would require, you could choose between these two categories of funds.
Okay.
And equity hybrid, which is earlier known as balanced category, obviously has more than 65% in equity all points of time in terms of directional equity. So it is the most aggressive product among the hybrid funds. The dynamic asset allocation products, however, move their equity between 20 to 80 or 30 to 80, for example. And those are still coming in equity taxation category because whatever is the gap between 65% and the actual directional equity is supported by arbitrage provision. So from equity taxation perspective, they are also part of the equity category.
So there you have it, some idea of how you can go about picking these funds. Now, Devendra, on some of the major categories, because these days we do see a lot of mutual fund houses talk about the balanced advantage or the dynamic asset allocation, as it's called. A lot of commentary around these funds, because here the fund manager has the full flexibility, right, to decide depending on market conditions if you should be in more in equity or more in debt. So what are the advantages and maybe even disadvantages that investors here should be aware of?
See, the biggest advantage of a dynamic allocation, which a balanced advantage fund provides, is that you yourself need not balance your equity or debt allocation depending on the market conditions. The fund managers does this job for you, and we have seen that most of them have done a pretty decent job in the past few years, ever since this category has been there. So depending on where the valuations of the markets have been, the fund managers have taken a call to increase or decrease the respective equity or debt in the portfolio. So that is one big thing. Second is, as with any hybrid funds, if an investor just wants to keep putting money and just have one asset, one fund if he wants to put in, then I think this is one category whereby he can basically not bother about what his other allocations would be and leave the judgment best to the fund manager to decide where his overall equity allocation would be in the market at a particular point in time. So I think that is the beauty of this product, and this is the biggest advantage, that it basically makes it really simple for the investor to keep putting money for a longer term and leave both the asset allocation and the stock selection judgment to the fund manager's ability.
Harsha, so coming down to the final word on both the funds that we've discussed today, actually, tax saving as well as hybrids. Risk is very important as well, right? And we can't end the conversation without talking about the riskometer or the risk measure of many of these funds, specifically debt hybrids, because we know that the fixed income market has been very challenging for investors over the last 1 to 2 years. So your final words and advice on both the categories.
So clearly, if you look at our overall cycle and over the long term, fixed income return range has been much smaller. The volatility has been lesser. So all those hybrid products which have higher allocation to fixed income over a cycle will have lesser volatility than equity funds, for example, ELSS, or the hybrid funds which have higher allocation to equity. That being said, the higher volatility is also compensated by potentially higher returns in equity markets over a cycle. And if you are able to really invest in a disciplined way and maintain that balance between risk and reward, you would end up having better returns from pure equity or higher equity allocation hybrid funds. Mm-hmm. So every investor will have to evaluate what kind of risk one can take, and what are the kind of lock-ins and overall investment horizon should be there for each product. I'm afraid that you can't have one single proportion or a ratio for investor to invest between equity and fixed income. So every investor should ideally speak to their financial advisors and arrive at a optimal asset allocation between equity and debt. They can do it through multiple funds, or they could choose hybrid funds where they can do that asset allocation in a single.
All right, gentlemen, thank you very much for taking out the time and educating us on some very, very important concepts when it comes to both the ELSS category as well as hybrid funds. We look forward to our next conversation. So, well, that's it on this episode of Investmentor. Hopefully you found these conversations very useful, and we'll come back next week with some more fund categories and some more pieces of information that can help you make the right decisions when it comes to your mutual fund investments.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.